Yep.
And top of the morning to you on a Monday morning.
All right. Happy morning. Happy Monday.
Cheers.
Cheers, guys.
All right. It is bright and sunny and windy and cool in South Texas today, so it's beautiful. It's beautiful.
It's rainy and gloomy here.
Yep. It was rainy yesterday morning. Yeah, it's very sunny in Texas. And it's super windy yesterday. We drove out to Mineral Wells, which not a good.
Yeah. Familiar with Mineral Wells, Texas?
I'm closer to Brad now. I'm in Lower Connecticut.
All right.
Which city?
Milford.
Milford.
So a little south of New Haven.
How close is that to Mamaroneck?
Mamaroneck, New York?
Yeah, but isn't Mamaroneck, New York, like right on the border of Connecticut, New York?
I think so. It's been a long time since I've been to New York.
Okay, here we go. Let's look at a deal, and then let's do a check-in with everybody. So we're going to look at Brad's deal here. Let me do a screen share. I think I can do this here. Okay, so let's do the desktop. All right, let's do this. Let's do this.
Wow, look at that.
I love it.
My art.
Your what?
Warrior Man book.
Oh yeah, you're looking at it. Yeah, these are my private files. Thank you. Yeah, that's the book I'm writing. So anyway, let's go to all right. So we have two it's a deal with two properties in it. It's an offer with two properties. Okay, and I think did we show the letter that we did? We showed the letter the other day that we got back from the listing realtors, didn't we? Yeah. Yep. Okay. So essentially, they said come back to us with a different offer, about 150,000-ish more for the two properties. Actually, Letitia and I, we dove in on this, and I mean, I had some underwriting, but then we're like, okay, let's really crunch it. Let's really, really crunch it. So this was our date night on Saturday. actually more almost as anyway. So let's see what we got going on here. So the difference is, Brad. So you know, we broke down everything, every single studio. Okay, here there's some 1.5s, etc. Okay, there's a total of 46 units, but the 1.5s were empty. Okay, so there's five vacancies. Is this screen big enough, or do I need to pop it to right there? Yeah. All right, so we start off with the asking price of 1.8. The stated gross per the T12 that they sent was 263 with an NOI of 103 right there. We plugged in 6% market cap, and based on these numbers, it made it look like a decent offer over here. Okay. Now, this particular property, we said it's going to be 18 units of rehab times $4,000 worth of rehab, $72,000. Now, here's where things started to get interesting. So the total rent, the total gross effective rent was $23,000. So just for review, guys, what is the gross effective rent? That's a question.
Well, the gross effective rent is the rent you are actually collecting.
Okay, so somebody else?
Isn't it what it could be?
Correct. Gross effective rent is if all units are rented at the full price. Okay.
Mm-hmm.
So in other words, you know, 100 units, 100 doors, it's you know, $10,000, right? That's if everything is running perfectly.
Oh, so you take out vacancy?
Correct. You take out vacancy. So this particular calculator takes out a couple of things. You know what? I'll tell you what. The spreadsheet that they sent over was decent. Let me go find it and show you. We're looking at Countryside, are we?
Yes.
I don't think it's in here. Yes, it is. No, it's not in there. That's this one. 1 second here. Here it is. Right, rent roll, plantation. Okay, so let's take a look at their income statement. That's not it. Rent roll. Hello, income statement, place, Countryside. Here we go. Come on. Okay, so this is a pretty nice statement that they sent over. You don't always get one that's this, this clear to read. So I like that. All right. The thing about this, you're never going to. Let me just tell you this right now. Okay. All of their account names are never going to line up with your account names. When you get over to the expense side, they're never going to line up perfectly. They're not going to call their water and sewer the same as you call water and sewer. So you have to kind of be a little bit Sherlock Holmes and figure out what they were thinking, and you got to plug in their number. That said, this one was fairly close. So let's look at income first. So they have gross potential rent. All right. So this right here, this line right here, Peter, is if everything were rented up 100%, they say. Okay. Now you have these items that come off of it. So a gain on a lease is you leased it and they prepaid, or they paid, in advance, or you got a higher rent than you're listed for whatever reason. Okay, you listed it at 600, then they're coming in at 625 for whatever reason. All right, your loss to lease is just the reverse. You listed it at 600, they're paying 550, you lost $50. So this number is always going to be there, okay? Because for whatever reasons, like if in a best case scenario, if all things were really humming along smoothly, you got 100 doors, you rent them out for 500, you get $50,000 a month. Period. End of story. But that doesn't happen. So you've got people that pay 450, 425, 475. They negotiated. The property manager was in a generous mood that day. Whatever. All right. Then you have vacancy loss, and that's just what it says. You have 50 doors, or you have 100 doors, but you only rented 95 of them. So that 5 times your rent base, your rent rate, is your vacancy lost. Okay. So that's got to come off of it too. And then your delinquency income is that's people who walked out on you. Okay. Now over here, that's automatically calculated in this particular spreadsheet. That's automatically calculated in vacancies. Okay. And it's taken out for vacancies. Okay. Excuse me. All right. So then you come up with a gross scheduled income minus the vacancies, and that's your income right there, your effective income, 283. Now that doesn't match the other spreadsheet, so we got to start figuring out why. Then we find the other spreadsheet, and let's see. Let's do the expenses. By the way, you're going to look at other rent charges. Like you see here, they put in late fees, application fees, month-to-month fees, NSF fees. Somebody left early. Building and facility fee. I don't know what that is. I'm going to say that maybe that was, they rented a party room. I don't think they have any party rooms on this site, on this property, do they? Don't know exactly what that is. So when we do a due diligence, like on site, we got to figure out what that is, because that's on this particular property. That's a fairly significant number. You have any idea what that is, Brad?
I don't know.
Extra
What
story.
is this amenities fee?
This could be storage. This could be an extra parking lot. I mean, extra vehicle that you're allowed to park. This could be, you know, some places have carports and they charge extra for. This could be a number of things. What are you asking? Where are you looking? Application fee? Did you say? Who asked what? Mark, did you ask a question?
I think I said amenities.
Oh, you're asking if that could be some amenities that they charge for?
Yeah.
Yeah,
Like instead of
possibly.
tagging on to the rent, it's like an extra $20 or something.
Yeah,
for
possibly.
amenities, like they
You
do
know-
for hotels.
Yeah, I evaluated a deal last year, and they were next door to a YMCA, and they made a deal with the YMCA. You know, the YMCA normally charged whatever they charge, $75 a month, and they were giving a discount to the people that lived in the apartment next door, $50 a month, and that was revenue.
Where's the laundry? If there's no laundry, maybe that's the laundry.
Could be. I don't think, I don't know if there's laundry on this property. Was there laundry?
Right there.
There it is. Okay, it's not that.
Yep, laundry facility. Okay. Legal, let's talk about this. Okay. That's pretty clear, you know, that's clear. So people used up their deposits, laundry, legal income. They probably sued some people, evicted them, and they got reimbursed for legal fees. I guess they went out and got the money, you know. Lease violation income, who knows? Somebody parked 3 cars when they only paid for 2. Somebody let their dog poop and they charged them. Who knows what that is, right?
There's your.
Yeah, it could be an extra key, you know, extra keys, extra key charges. Somebody lost their keys. Well, there's some right there, keys and locks. It's not much, but it's you know, management can get crazy sometimes with these fees if they really dig into the weeds of the lease, okay? All right, so those are your other incomes. And by the way, when you go to evaluate a property, you want to look at these closely because 1, they may not be charging enough. 2, they may not be charging at all, right? So it could be an income stream. Right, this little thing right here, I think I've mentioned it. Those little fobs, those little gray round, they're fobs that are about the size of a quarter. You know, you buy those for like $12, but you turn around and charge $40 for them. So every time you lose one, there's $40. So a lot of apartments do that. All right, so that's the income. All right, any questions there? So then we go start breaking down the fees. And on this underwriting template, what this does is at the top you put the taxes, but then it automatically adjusts it uh, 10%. So it went up 10% there, $1,700, right? And then you just go down the sheet and you start pulling out in the expenses as they see them. This management fee, we adjusted this because the fee itself, come on, was 11.8. That was the actual management expense. And we'll cover that in a second, Brad, because they gave us information on that one, which I don't agree with, but anyway. And then you just continue to you know, plug in the numbers over here. And then what we did is we highlighted them so we don't double enter them. As they were entered, we highlighted them. Okay. They're pretty good about, categorizing their expenses. So that was good. This is kind of fun here, background screening. So they're paying a third party to screen their tenants. There's your pest control, there's your landscaping. And then here was all your taxes and insurance down here. All right, so let's go back over here. So we plug all that in. You bump a little bit for the taxes because you're going to have to when you buy the property. Management fees lined up. We put in capital reserves because this is capital reserves or CapEx reserves. This is, to repair, fix up the any damage that may be done or improvements to the property, right? This would cover, get this would cover a deductible, an insurance deductible also. You could use that for an insurance deductible if you had damage to the property. But look what's the problem you see here on this expense layout. What's the problem?
The reserves seem low. Telephone, 0.
Well, what we did on the telephone is we put internet and telephone together.
Okay. What about
Yeah.
flood insurance?
We put all of that under insurance right there.
Okay.
Yeah.
A management fee, aren't you going to increase that and just for future?
This is 46 doors.
Okay.
So for 46 doors, what they did was, and this is the thing that they're telling us that, they're telling us where the value add is. So we put 4.5% because it matched the their expense statement. But then they also add, see here, a property manager. Pardon me. They also add a property manager.
Oh,
So actually, that's $54,000, almost $55,000.
That's huge.
Yeah, that's a lot. Okay. What you notice here though is that your expenses are up north of 62%.
Yeah.
So remember, we like to see them 40 to 50, 45 to 50,
oh, yes.
55 at the tops, right? So that's and how do you lower this? Anybody? How do you lower this?
Get rid of the property manager.
Raise rents.
Raise rents, lower expenses. End of story. Raise rents, lower expenses. So somewhere in here, something's got to be trimmed. Okay. Something's got to be trimmed. Something's got to be raised. All right. But, okay, so this is actual. This is all actual. We're going to borrow 75%, which, by the way, I think is probably going to be in closer to 70%. Let's just see what that looks like. Okay, remember, currently we have a DCR of 1.27. See, now we got a DCR of 1.37. This is 30. Okay, so this is actual. So this looks good here. This doesn't look good. But on the current tab, this is okay in terms of, okay, where's our value add? Where's the money going to, where are we going to make the money? The interest rate might be a tad high, but I don't think it's going to translate into many more hundreds of dollars over here. If we underwrite it at 4, yeah, it changed $350. Okay. But I got low cash on cash. Stop. I got low cash on cash, and I got low cash per unit. This should be 100. This should be 8% at this offer, 1.8. And remember, they want us to go up from 1.8. So let's look over at the projected tab. So on the projected tab, what we then do is we increase rents by 3%. Now, I actually went into rentometer,
yeah.
And let's just do that. Let's display that here. I think it's still up. Rento, here it is, rentometer. Let's see. So let me refresh this. What's that address? Brad? I've got it over here. Hold on. Country Gardens, Beth Barber. Okay. This is the one right here. Oops. Okay, so the 1 bedroom, excuse me, the 3 bedroom, let's go back in. We had mostly, so the 2 bedroom, by the way, guys, this is the paid version. I'd recommend you get the paid version. It's like $50 a year. Okay.
Okay.
So it just gives you so much information here. Okay. So the average is 717 for a 2 bedroom. Let's see what the average for a 1 bedroom is. It's 535. So we go back to our underwriting. And the 1 bedroom, we wrote it at 5. Is that it? 5? No, I'm sorry. There's the 1 bedroom. 5. We wrote it at 525. Okay, we wrote it at 5. The average was 535. We wrote it at 525. The 2 bedroom, we wrote it at 695. Let's see what that was. So it's 717. So we wrote it at 695. So you can see we're being conservative. And there's some reasons that go into this, some things that factor into this. The age of the property. This property was built in the early 80s, so that makes it close to 40 years old. As you can see in the let's see, our subject property is here. So on this particular website, we can go and we can check other, the nearbys, right?
Mm-hmm.
Oh, was this for 2 bedroom or 3 bedroom rent?
This one here is a 2 bedroom.
Okay, because the property manager I spoke with said 550 max, 625 if you completely renovate the entire unit.
625 on a 2 bedroom.
Yeah, if you completely renovate, like new kitchens, new cabinets, paint, carpets, everything. He said
So that would be 625 right here, projected rent.
Yeah.
Okay, well then, there you go. And what do you say on the 1 bedrooms?
1 bedroom, he just said that 450 was about the market rent.
But they're getting 470.
Okay, so then, I mean, maybe they're a little higher.
Well, we had 2 properties. You on the right one, Country
Yeah.
Place?
No, I'm on the wrong one. Yeah, Countryside is 15% higher than those numbers.
So there's an actual right now of 470 on the 1 bedroom. So what would it go to? 15%, you
15%
said?
more. Yeah.
Wow.
Huh?
That's like $150 increase.
Okay, let's get real here. What is that? 470 plus 15 is what? Somebody? 15%.
Oh, no. $70.
So 540.
Yep.
Okay, so they say excuse me, they say 540. So let's go back and do a 1 bedroom over here. Yeah, we're not off. We're not. I wrote 525.
Okay.
The average is 535.
Okay.
Median is 5.25. They say 540.
Yeah.
So they're a tiny bit optimistic. Okay.
Okay.
So we should be right, but let me go back and change that because what was that a minute ago? 5. What did I do here?
Are you going to be rehabbing these? Because the 75%.
Oh, no. I'm sorry. Go ahead.
The 75% tile rents on Rentometer were much higher. So I'm wondering if you're rehabbing these, then you'll probably end up in the 75 percentile. So I would say that they're not being conservative. They're not overshooting it.
Let's look at that again. Good morning, Nina.
Good morning. Sorry, I'm a little
Good
groggy.
morning, Nina.
Morning.
Hey, guys.
Okay, so this is the,
Sorry.
okay, this is the 1 bedroom, and this is what Rentometer says, 535. Okay,
And then look at that 75 percentile.
yeah,
So that's just essentially saying that that 75% the property of the rents are at 565 in that range. So I would say if you're going to be rehabbing any of the units, then they're going to fall into the higher range. So I like being conservative, but I don't know that their numbers that they're giving you are necessarily
they said 540, did they?
yeah.
Okay,
So I'm thinking that they're probably
not
falling
too far off, yeah.
into 75%.
I mean, if you want to cheat a little bit, we'll put here 535. What the heck? Let's put 540. Okay.
Well-
All right. Just remember, this becomes your business plan, right? So, and while this is, you hope to have, maybe 70, 80% correct at this moment. Once you do due diligence, then all this really tightens up. All right. So let me go back here and do this. All right. So then now we come back to our expenses. And we raised rent. We didn't trim expenses all that much because the current tab, the expenses were 172,908. They're still 172,908. So we kept the expenses, but we raised the rent. Takes our income to expense ratio down to 53. So we trimmed off about what, 9 points there, 9%.
Yeah, that's better.
That's much better.
Where else do you trim?
Yeah, we'll have to. So this is where they say that we should trim on salaries and management. So remember, this is a 2-property package, and they say you're going to use 1 maintenance guy and 1 salaried person to go between the 2 properties and manage. So then I went to Google Maps, and these properties are 20 minutes away, and they are, and what separates them is a major highway. So to me, that sounds like major traffic. Okay, like the loop or whatever you guys call it. Where you live, we call it the loop here, right? It's the major highway around the town. So I'm not real comfortable in having 1 operate 2 because the other property is 76 doors. 76 doors, is that right? 78 doors? 78 doors. And you're that's pushing now you're over 100 doors, right? You're 120 doors or so. So I left it like this. Okay.
Hey,
Pretty good DCR. Stop. Pretty good
yeah,
DCR.
there. On that
Getting
fee, real quick.
What's that?
On that management fee, is that for just this 1 property for on-site, and is that what their salary they're going to be paid, and is the manager getting free rent?
In reverse, manager, there's no concessions for the manager included in this. And on a 46 property, you really shouldn't, Second, this goes to the property management company, and this goes to the personnel that you have to hire for the
Right.
property management company to manage.
Right. I get it.
Okay.
I just wasn't sure if that 43,000 was in addition to a concession on rent. So that would just not good.
They don't have any concessions. We didn't see any concessions on the expense sheet.
Okay.
Okay. And, we're 95% occupied here. So I'm going to try to steer away or avoid a concession for a manager.
Got it.
Okay. But I'm back over here to the 3070, which means I have to raise money. So the projections look a bit better, right? You know what, Brad, let me go back here and put back in here 75-25 because that's the evaluation that I sent to you. Okay. And then the other evaluation I sent to you was this rent was not 540, it was 525, right?
Yeah, I think so.
Yeah, let's keep them the same. I mean, we're talking, you know, a percentage here and there. Okay. Let me hit save because you know how that goes. Stop.
What are you projecting for rehab on these units?
Why does it do that?
Because-
$4,000 a door, for 15 or 18 doors, was it?
18, I think.
18 doors, 4,000 a door because they've already rehabbed the others.
What's your make ready amount there? Oh, gotcha.
Why is that? So this make ready came off of the expense sheet, off the T12.
Oh, okay.
Yeah, all the expenses we just left.
Got it.
Okay. But we increased our property taxes and we added a capital reserve.
Got it.
Okay. So this is not too shabby right here. Okay. But now here's the thing, Brad. We're going to go look at the deal structure because now we have to turn around and sell this. You have to sell it to investors. Okay. So this tells us that our investors, somebody, has to bring $654,000 to the table. All right. Let's go back here and look at the current. This is where we get this. You got a down payment. You've got closing costs. You've got debt reserves, and you've got deferred maintenance repairs, remodels. Okay. And then you've got a 2% acquisition fee. Where is it? Right here, 2% acquisition fee. And so all of that adds up to a $654,000 raise. Okay. So now, excuse me, hold on. So now, if we do a 30-70 split right there, that gives our investors a return, an annual return of 22%. So that's not too shabby. Okay.
Hello.
All right. So that's Country
Per
Place.
year, over 5 years or after 5 years?
So let's do this. Okay. So each year the property will profit the total of 39 plus 13 plus the asset fee, 6,000. I'm sorry. Let me back that up. The total of the asset fee, the operator's profit, 30%, and the investors. So 39 and 16 and 6 adds up to this right here, 62, the cash flow. All right. So 1, 2, 3 times 5 years. So they're getting, you know, the property is going to make 1, 2, 3 times 5 years. And then at the end of 5 years, once the property is sold, they get a 70% share of the equity of the profits. So you take these 5 years plus this 500, so 5 times 40, let's say 5 times 40, that's 200,000. That's 712,000. And this is, I'm not right here, okay? So that's 712,000. So 650, they're going to get back 712,000 on their 654, which is 4% a year, I think.
712,000.
This is what's weird right here. Go ahead. What did you say?
Well, where's the 712? Because I see 512 there.
Well, I took, they get 5 years. I rounded up to 40,000 times 5 years.
Oh,
That's
gotcha.
200 plus 512. They get back 712.
Share of cash flow. So that share of cash flow is only 1 year, each year, the share of cash flow column.
Yeah, just a
You're
second.
assuming 5 years. Okay.
Well, what happened?
he's got a year 5 down at the bottom. Oh no, that's year 5. That's something else. Maybe not.
This is definitely the better of the two deals, Brad.
Yeah, obviously.
Let's look at the other one for a moment. Where'd it go? Here it is. Let's just jump to the deal structure page. On this one, oops, your investor's got to bring 1.6.
Another $1 million. For a return of,
For a return of, let me size this down. 3.6%.
that's a big drop. Is that right? That's a big drop.
It's huge. But this one, it has 57% expense ratio. Okay.
And a huge reno, looks like. We've got 360 there. 360.
316. So we're doing 40 units times 4,000. Oh, that's right. That's what happened. I messed this up right here. This is 160. We messed this up right at the last minute. We messed that up. I remember. Let me fix it. Okay. Oops.
You just got to take that whole thing out.
Bingo. All right.
There you go.
All right.
Well, at
So
least
let's-
the DCR, oh no, the DCR is still at 116.
Yeah, let's go back to the deal structure. So it bumped it up a little bit, 5%. They get 5% on their money.
What the heck's wrong with it?
That's what I'm trying to figure out. Don't quite know unless, well, I mean, let's leave our assumptions the same here. The capital stack is the same, interest rate is the same, term is the same. We got a low cash on cash return, we got a low per unit. So let's go over to the projected. What can we do on the projected? Come on.
And the
That's
debt
it right there. I'm sorry, that's it.
that rate, you're assuming this for an acquisition after COVID?
Yeah, I mean, realistically, everything I hear, this is probably going to be closer to set 3. Oh, shoot, don't do that, Paul.
Closer to 7, yeah.
No, closer to, what did I just do?
Hit escape.
Escape.
Hit enter. Just hit enter.
Nothing.
No, hit. Oh boy, you're having problems, huh?
Escape. Heart attack. Save. Okay. This is, it's really going to be more, probably closer to 375.
Really?
37. Yeah. So, I mean, let's just do it, right?
With what lender?
Yeah.
So the
I'm just
payment
trying
is
to understand.
15,000 versus, see, 15,400 versus 16, so $600 more.
I heard some lenders are requiring a DCR of 2.
I don't doubt it. It's so up in the air right now. This one is 1.3. But this is where this is where we have a problem right here, Brad.
Yeah.
Like, even if you combine this with the other one, that is
27, 28.
yeah, that's a 14% return between the two, which is harder to sell. 18 to 20 is easier to sell. 14 is challenging to sell. And they want us to raise the price,
Right.
150 grand.
I think looking through your all your data here, I think you suggested 3.7 was more the price we needed to be at instead of 4.
Yes, I think so. But we already put in the offer and they want us to go up when we should go down.
Right.
So let's just do that. Let me let me get
all over the carpet.
Come on. Okay, let me pump this to 125. So let's just play the 3-7 game, okay? So there's your DCR, but your return on cash is still low. You get a little more by the unit, but not much more. And then now you're at a 9% return versus what was it a minute ago? 5.5?
Yeah, 5.5.
But still, if you take that 22, 20, 22, and 10, 32, you're still at a 16% between the two.
Well, but still 9 is at least a little bit better. I mean, you can say 8% preferred return, even though that's showing more. You're able to do at least an industry standard. I'm trying to still wrap my head around that rate, though. I don't see how you're able to get a loan at 410, let alone 375.
What would you put it at?
7.
7?
I am not kidding you. 7% on these loans right now.
And this is post-COVID?
This is current. So if you're looking at this as post-COVID, when the lenders, decide to come back to humanity, then yeah, you're fine with where you're at.
For a deal like this, I think that the way to make it work is, contractually is to say, let me get off all this. Contractually is to say, let's do a contingency of some sort based on lender financing at certain rates. I think because of the uncertainty of the lending.
Well, what's your thoughts on just as it sits? As soon as I saw your all these on Saturday,
That makes sense.
Countryside looks okay to me. This one just looks terrible.
We can offer only on Countryside, but it doesn't sound to me like they want to do that. They want to. Okay, let me back up. Let me answer your question. I don't think we need to raise the price. In other words, we got to stick like it is. Okay, at least, and then, and then we can go. We can say, based on further review, we're going to stay with the offer we have, and put a few contingencies in it. Like we got to get owner finance. Lender approval. Now they're requesting from us lender approval anyway, right?
Yeah.
So I reached out to lenders. They're going to work on it. It's going to take a day or two, and but they're like they don't even know.
But as it sits right now, it's not hitting our preferred return. So
No.
Why even stay? Why not come back with either just going with one of them, the Countryside, or because if they said let's move forward with us, then we're gonna have to go take a look at it. We already know we need to be at that or cheaper.
Right.
What's your preferred return?
8 or better on the
Okay.
cash on cash.
Well, you've got 9 and change on the funky one.
And then
Sorry.
and then the investor return needs to be 18-ish.
Ah, okay. That one's only at 9.25, so you're only at half of it.
And if you add in the other one.
Yeah. Well, cumulatively, the investor's return is well over 18. Because the other one is,
It's 22 and 9.
yeah. So you're
So
at 31.
You're at 15. That means you're at 15.5.
Oh, because you have to divide them by 2. Yeah. So that's, well, you said the investor's return has to be 18?
Yeah.
Oh, so it is bringing it down.
Yeah. All right, Brad. So what do you want to do?
Well, I don't want to get myself into my first deal on something that's not going to be you know, where we need to hit on terms of returns.
Too marginal.
Yeah, I think if they came down maybe to the 3.7, then maybe we have something to talk about. But I mean, they still want us to go up at 150. So I mean, we're 450,000 apart right now.
What's the condition of the property? Is there anything you'll be able to do with retrade that you can project you might be able to do with retrade after inspections?
This is a pretty vanilla these are pretty vanilla properties.
Oh, okay.
2-story. You know how that one looks in Eagle Pass, the 32 in Eagle Pass? Remember we were on Zoom last week with it? I mean, on the Google Maps with it. Remember that? These look just like that. 2-story, one on top of the other, Nina. One on
Yeah.
top of the other, parking lot, some trees, outside stairs. You know, that's the kind of thing.
I mean, you don't want to force a deal. I know that's the best advice I've ever heard, but at the same time, when you have one that's at 22% that is achieving what's it going to take for the other one to bring both of them, if you're having to acquire both, to that 18% or better? And that tells me if their seller is motivated, why not, tell them, look, we're getting both for you. We're taking both off your hands. What can you do on the other one to be able to get the one that's lower at or below your current price? So I'm just wondering how you can play with the two, leverage the one that's better to be able to get the other one at increase the return on it. I don't know, just thinking outside the box here.
Yeah. Brad?
Aside from forcing the deal, I agree with Brad.
I personally don't think this is a deal that I want to pursue.
Okay. All right.
There you go.
I mean, I'm assuming you agree with that.
I do.
Okay.
I needed to lead you to water.
Oh, no. I mean, I came to that conclusion on Saturday. That's why I didn't even message you back.
Then why did you make me fret all weekend? I get too worried about shit like that. No, seriously. So as I look at it, it's like an emotional decision if you were to do it, and the numbers don't support it. Now, you could go back and say you'd like the Countryside. It's Countryside, right? Is a smaller one.
Yeah.
Okay. You'd like Countryside as is standalone price. Would the seller consider it? Because you can make that deal happen. Okay.
Okay.
The numbers line up. But and they know it, and they know that Plantation doesn't line up, and that's why they're saying pool the management together. Okay.
Okay.
And I just like, your response is that does not fit my management plan. Properties, properties need to be handled alone to create the most profitability and the best experience for the tenant, and the most profit, most profit for our investors. Right?
Makes sense.
Makes sense.
Yep.
Did you already do an LOI on this?
We did.
We did.
And they
Oh,
came back with, they want $150,000 more for the two.
for the two.
For the
Gotcha.
two.
So you're going to go back with, we aren't going to take the second one. We'll take the first one. That's our final move on this. Or if you can't do that, we're moving on.
Yeah, and they tell us, now listen, I always take the stuff like this with a grain of salt. They tell us that there's us and somebody else.
Oh, of course.
And they want us to make a strong case because the other person is cash. So like they ask us questions like, what's our capital stack? Can we get a letter of credit? I'm happy to answer all that stuff and provide that stuff, but that doesn't go to the numbers don't work.
Right. And more
Right.
importantly, they can say, well, we have somebody else, they're cash, because they have somebody else in their database that they could pitch it to. That person doesn't necessarily mean they're real.
Yeah, not for
So
150,000.
Yeah. So exactly. So I think, Brad, if I may, it's like structure, you draft an email and I'm happy to look at it with you. So, draft it says, thank you very much after contemplating it and running the numbers, our offer stands. In fact, we'd like to make an offer only on,
Lower.
the Countryside property. And, you know, we can perform on that. And you know, a 1.8 million, excuse me, it was 1.8 million dollar deal is a nice little deal for your first time out of the chute.
Okay,
Manageable, everything. Okay.
okay.
All right. All right. So who's got a update on their goals, their action items? Who's got one? I'm liking the background stuff there. I'm just telling you that.
Well, you know, I discovered the Reonomy.
Rentometer?
Oh,
Oh, Reonomy. Oh, Reonomy. Yes, Reonomy. Yes.
yeah, it's not cheap, but
Now, Reonomy is like CoStar, isn't it?
yeah,
Yeah. Okay.
but I've got 7 days, and I'm gonna get on a call in a half an hour or two for the guy to show me how to use it.
Mm-hmm.
More
What's 7 days? You mean a trial period?
Yeah, 7-day trial, and you get owners' phone numbers, everything. So and they don't have to be for sale. You just go and look at a property. In fact, right now, with the 7 days, you look at possible defaults, pre-foreclosures, and you could look at large apartment buildings, and they've already gone through. This company has effectively gone through the LLC, broken through that to find the people's names and phone numbers. And you can call them up directly and say whatever it is, whatever script you want to say. So that's my plan for this week.
Is that so you can do a marketing campaign to these folks, like a letter or postcards or those kinds of things?
I'm just going to call them up and have a discussion with them and say, hey, so we're buying in the neighborhood and we want to know what your experience is
Mm-hmm.
with the COVAG going on with your tenants. Are you seeing a shortfall in the collecting rents, or are you seeing people moving out? Or what are you seeing? And seeing what kind of discussion I can have with them to see if they're interested in selling.
Okay.
You know, I want it to be kind of a roundabout conversation about just what their experience is.
Personal contact. Okay.
Yeah.
All right. Good. How much is that Reonomy? Do you know?
Well, the basic one says $299 a month, but of course the more advanced one with a lot more bells and whistles with the pre-foreclosure is unknown. They want you to have a discussion with them about that. So it's probably close to CoStar's price.
I only paid $200 a month for CoStar,
Okay.
but then I got that discount through my brokerage. So,
Mm-hmm.
And $100 to
think-
Nina, you get it for 50% off.
and then, yeah. And then when I was looking to go to EXP, I talked to Ryan, who's the CoStar rep for California. And he was telling me that they just renegotiated their brokerage rate, which was somewhere in the neighborhood of 300 or 325 a month.
Hmm.
You do get owner data in CoStar. So you do have to send it to your VA for additional skip tracing, but it's worth it.
So
Yeah.
I think as a group, seriously, as a group, we should let this evolve and talk about a marketing plan. Like, how can we all share this? Because I've told you guys before, I depend heavily on referrals and I depend heavily on my broker network, right? So I've never really done any outbound marketing to speak of. Like sometimes I'll go to a property next door, that kind of thing, or sometimes I'll just drop in if I see an ugly property, right? But that's rare. Like if I go through 100 deals, maybe I dropped in on one of them. Okay, all that to say, like maybe, we should let this evolve and see if there's a group effort, if it warrants the cost. Like they can give you all the Fort Worth. I'm using examples. They can give you all the Fort Worth, and Brad, you can pull all the data from northern North Carolina, and I can pull San Antonio, and we just we just Nina, you can pull Georgia, and whatever, right? Saying we just we figure out a disciplined, targeted marketing plan based on all the different kinds of strategies that are out there, from cold calling to letters, to postcards, everything.
Yeah.
Why don't you get us some initial information and see what that sounds like? Okay, because the off markets are really the way to go.
Yeah.
You just got to have a disciplined, consistent approach to it. And it's not a thing that gets handled, in 3 months. It's a thing that gets handled in 18 months.
Yeah,
Yeah.
for Reonomy, they presented to our brokerage to join them and to take their services. And basically, if you have a team, they charge, basically, they treat it like an enterprise account where they're giving you 5-6 licenses at a discounted rate. But it's not as discounted as you might think because, of course, the team can share info. So they do it just like CoStar. They don't want CoStar to share their info with other brokers. That's how they make their ducats for each membership. So with a team, they'll give you a discount on an enterprise account with multiple licenses, but it's not going to be that significant.
Is this a Zoom call you're having with them or just a phone call?
Oh, no, they did I'm sorry for Peter. Go ahead.
Well, just a phone call as far as I know. I'm sure he's going to maybe, who knows? I don't know.
Okay. Anybody else want to share their actions, their updates, action items?
Just doing the same things. I should get my final draft of that presentation today. But yeah, I mean, just the same stuff that I spoke about last week.
Okay. All right. Mark, how's your bio coming along?
Once again delayed because I had to make a move physically.
That sounds so mobsterish. I had to make a move.
You have no idea.
Okay, I'm going to encourage you, my man, to continue to do that and make progress. And again, if there's any assistance I can offer to you, you just reach out to me, okay? Wednesday starts the new group of 30-day challenge, and it looks like as of this morning, I had 13 new people, all right, or 13 in the group, right? So I just got messages from 2 more. They're ready to come in. So it looks like we're going to have a nice, healthy-sized group. And so I just want to let y'all know that it's when we start, some of it will be repetition because it's a methodology, and but I'm a believer in repetition. So this time I'm going to put in more homework. I've been working on it, so I'm going to put in more action items, through the days. And let me just say this: I am so happy that you guys came through the first 30-day program, and I'm glad to get to know all of you. And I look forward to getting to know all of you even further and doing deals with you as we go further. Beginning Wednesday, all of our communication will now be in the new 30-day group. I keep the other one alive because it's got all the documentation and everything in it, right? Videos and everything. But the new group, I'll now begin communicating through the new group starting Wednesday, okay? And so I can just focus on one group there, communication-wise. I'm working with my web designer right now. And I think it looks like all of the videos are going to be able to be put on my website, and they're going to be password protected. So I think we're going to have that done by Wednesday. I'm crossing my fingers. Scott, this is kind of new for me, putting together a formal program. So in this fashion, so I want to continue to improve. So I think password protected in a private site that people go to is the next thing that I can do to make it professional. But anyway, along the way, I mean, just like nothing stops between us. Let's just keep, stay together and keep communicating. And then there's a new batch of people. Some people in there that I know, and some people I don't know. Like I don't know where these people came from, other than they saw a post and they're all jazzed up. I'm like, okay, great. So I think it'll be real interesting. There's a wide variety. I got a bunch of real estate people that come into this next one. Like, looks like they have some experience, right? So that's going to be cool. Anyway, that's all I got for today. Okay. Cool. Thank you guys very, very much.
When's the next together?
Wednesday morning, 9 a.m. And that's the launch of the new one, right? So
Oh,
everything you
okay.
hear, everything you hear on Wednesday morning, 9 a.m. will be welcome. And you remember session 1 was you need some tools, right? And these are the tools you need.
And is
So
it this same Zoom room or you
it's the
use?
same Zoom room. Yes, it
Okay.
is. It's the same Zoom room. Yeah, we'll do the same Zoom room. All be recorded. Everything the same that way. Okay.
Because if
But
I
I'm
don't
gonna
send them,
post.
I keep-
I'm gonna post that in the new 30-day group, right? The link and the welcome and all that is any business that we have. I can put it for the next day or so in the other group, or going forward, whatever. But the new group will be all the new links and everything. Okay.
Fantastic.
Coolio. All right. Catch you guys soon.
Thanks.
Okay.
You're welcome.
Wednesday.